Cash Course Plus. Trade with confidence. The Fibonacci sequence was discovered by Leonardo of Pisa, popularly known as Fibonacci, in the 13th century. Traders later applied its key ratios, 23.6%, 38.2%, 50%, 61.8%, to predict price pullbacks, turning it into the Fibonacci retracement indicator.
So let me give you a quick example with my favorite collection of numbers, the Fibonacci numbers.
When I learned about this math ratio, it changed my life. A math and design phenomena called the golden ratio. Well, to help explain it, I'm going to put out this sequence of numbers called the Fibonacci sequence.
They're called the Fibonacci sequence.
How would it feel to be among the top % of traders who make consistent profits in the financial market just by mastering the Fibonacci retracement indicator? Imagine spotting high probability pullbacks, entering trades with precision, and riding the next big move, all by applying a single yet powerful indicator. There's no guesswork, there's no stress, just repeated success, guys. In this video, we are going to unlock the secret of trading pullbacks using
Fibonacci retracement.
You're going to discover how to identify key levels, time your entries like professionals, and then place the odds in your favor. Guys, this could be the next missing piece, or should I say this is the missing edge that you have been searching for. I promise you that. So stick around, because by the end of this video, you will never look at price action the same way again. Now let's dive in. So guys, the first question that is probably running through your mind right now is, what is Fibonacci retracement? What is Fibonacci retracement, and how do we use them to enter a trade after a possible pullback? Well, Fibonacci retracement in trading, Fibonacci retracement is a trading tool that helps predict where the price of an asset might pull back before continuing its trend. I'm going to repeat it again. Fibonacci retracement is a trading tool that helps predict where the price of an asset might pull back before continuing its trend. Remember, I said it helps to predict where the price of an asset might pull back, right? Now, what does pullback mean? A pullback is a temporary shift in the opposite side of a current trend. For instance, during an uptrend, the pullback is the price going down temporarily before it continues the uptrend. And then during a downtrend, the pullback is the price going up temporarily before it continues going down. Let me give you an example. Now, in an uptrend like this, as you can see, this is clearly an uptrend, right? Since the market is going up. Right, so you're going to see that the market just doesn't go up singularly like this, right? It makes patterns, right? It makes patterns like this, right? Like this, giving the small pullback. So this is what we call the pullback. As you can see, there's a rise in market right here, and then a pullback came, right? Like sellers are trying to, sell off the property. Then the asset is going to reduce in price for a while before it continues to go up and then pull back, then goes up and pull back. So these temporarily opposite movements are called pullback. Right? So Fibonacci retracement helps you to see the end of a pullback before the trend continues in order to make you catch the trend quickly. Let's go to a downtrend example. Now guys, this is clearly a downtrend, right? This is clearly a downtrend. So the pullbacks on the downtrend is the price tending to go up, right? Just like the way it did right here, right? It pulled back to the upward side of the market before it continues its downward movement, and then also pulled back right here, and right here. All right, so these are the this is what we refer to as pullback in the financial market. Now guys, before we trade with the Fibonacci retracement indicator, you need to understand some key factors to maximize its effectiveness and avoid some common mistakes. Market factor is everything, guys. So there's the first one, we call it market context, right? So market context refers to the bigger picture of what is happening in the market before you place a trade. Market context refers to the bigger picture of what is happening in the market before you place a trade. So when they say market context, what it actually means is that when, for instance, if you're looking at a 15-minute chart, we are currently on the 4-hour chart, as you can see, right? We are currently on the 4-hour chart. So if you are on the 15-minute chart and you want to see the market context of this asset, Solana USDT, all you have to do is to go to the 4 hours, right? Is to come here to the 4 hours. Only then can you see the bigger picture, what is actually happening in the market in a broader time frame, all right? Only then can you be able to go to the 15 minutes for your entry, right? So you need to look at the market context, and Fibonacci works best in trending markets. All right, Fibonacci works best in trending market. When I say trending market, I mean an uptrend or a downtrend. So in order to use Fibonacci retracement perfectly, you need to make sure the market is a trending market. So when you hear a trader saying trending market, it means the market is either going uptrend or downtrend. An uptrend is just markets, all right, buyers having control, market going in an upward direction like this, and then a downtrend is when the market is moving in a downward trend like this, all right? So Fibonacci works on these types of market very perfectly or very conveniently, other than markets that are in the sideways motion like this. This is a choppy market. It's a choppy market, and Fibonacci doesn't work so great in this type of market. All right, it works perfectly good in either an uptrend or a downtrend. That's just what market context means. So most traders avoid using Fibonacci retracement tool in sideways or choppy markets. All right, and I will explain more on this topic, right? So before entering a trade, you first of all need to confirm whether it is an uptrend or a downtrend on the broader time frame, because whatever we're going to do, we are going to look at it from the bigger time frame before we can be able to actually enter the trade in a smaller time frame in alignment with what we have seen in the bigger time frame, right? Not on sideways market. So factor number 2. So the the second factor is having the ability to correctly anchor the current swing high and low position. All right. So in an uptrend, all you have to do to anchor the Fibonacci, you're going to look for the recent swing low, all right, and then anchor the recent swing low. While on a downtrend, you should spot the recent swing high and then anchor the Fibonacci from the recent swing high, right? So to do that, we are going to turn on the Fibonacci retracement indicator. But before we turn on the Fibonacci retracement indicator, I know that there are some of the viewers here that will want to know what a swing high is and what a swing low is, right? We want to elaborate everything in details. So a swing high is the highest point where the market temporarily stops rising. All right, it is the highest point where the market temporarily stops rising. Okay, and then starts pulling back to the downside before it continues an uptrend. Now, how do you spot a swing high? So to spot a swing high, you'll see price making a higher high than the previous highs, then drops. Okay, so as you can see, this is an uptrend. Let me give you an example from this chart on the screen. This is an uptrend, right? Since the market is making higher highs and higher lows, right? So where is going to be our swing high now? So you cannot say this is your swing high because this is not the recent high. This is not the highest high. Neither can you say this is the high. This is also not the high. So our recent swing high got to be this place over here. All right, our recent swing high is this place right here, and Bybit has helped us to actually identify the recent swing high. All right, so this is how you can be able to identify the swing high. The highest point on the chart, the current highest point on the chart, is the recent swing high. Okay, so price might continue making higher highs, but as at that moment, that highest price on the swing on the chart is the swing high. Okay, and it is often seen as the resistant level. So resistant level is like a level where price reaches and then sellers bounce it back down. Okay, for instance, if BTC is trading at $95,000, and then whenever it gets to $100,000, sellers will try to resist the price from going above $100,000 multiple times. Then when the price gets to $100,000, maybe more than once, twice, or 3 times, and then price keeps going back down when it hits $100,000, then it means that $100,000 is the resistant level of BTC. That's just how it is. So while a swing low is the lowest point where the market temporarily stops falling and starts pulling back. All right, so in order to spot a swing low, the first thing is you're going to notice the price making a lower low than the previous low, and then the next low doesn't break the low. So as you can see on this chart right here, this is the lowest low that price went. Let me indicate it so that you can see. right? So this is the lowest low that price went. So after this low, the next low that occurred, which is right here, is not as low as this low over here, making this place the recent swing low. That was why Bybit did well by indicating it for us right here, so that trading might can be easy for us, right? So that is how you can be able to identify swing highs and swing low. So after identifying the swing high and swing low, the next thing is to study the key Fibonacci levels. So now that we know what a swing high and a swing low is, the next thing we're going to do is to turn on our Fibonacci indicator. Now guys, this is where it gets interesting. So now this is our swing high and this is our swing low, right? So all you have to do in order to turn on the Fibonacci retracement is to click on this place right here, this pencil icon. So when you click on the pencil icon, all you have to do is to actually move this settings, all right, this lines, just move it, put your hand on the bar and just move it to this direction that the arrow went, right? So you just move it to this direction and then click on this place, all right, this place right here, this place that I just indicated. Click on it, all right? Let's click on it. So this is the Fibonacci retracement. Then on the screen, you're going to see something like a plus sign. All you have to do in a high market, in a swing high market, which is in an uptrend, the first point you need to point out is from the swing low to the swing high. While on a downtrend, you have to point from the swing high to the swing low. I hope you're getting what I'm saying. So since this is an uptrend, all we have to do is to take this, all right? Just put your hands on the screen and then control it to the swing low, just like this, right? Then click on the screen to lock it and then draw it all the way to the swing high, just like this, and then extend it, right? So you have drawn your Fibonacci. Then the next thing you have to do is to click on the screen to actually pin it. Sorry, let's do it again, right? So click on Fibonacci, then you place it on the swing low and then draw it to the level of the swing high, just like this, right? After doing that, the next thing you need to do is to lock it, just like this. Now we have locked the Fibonacci retracement tool on our chart, right? So you're gonna see list of numbers right here. Let me zoom it out a bit so that it can fit our screen. So you're gonna see list of numbers right here, right? You're gonna see 0.0, then 0.23, 0.382, 0.5, 0.61, 0.78, right? These are all numbers that are very, very important whenever you are using the Fibonacci retracement indicator. So I'm going to explain what all these levels stand for, one after the other. Guys, listen to this, please. This is one of the most important parts of this video, right? So when your chart, okay, when the market or when the price is on 0.0, okay, on this level, let me zoom it out a bit. So when the price is on 0.0, just like this, all right, so this price, the current price of Solana USDT on a 4-hour time frame is on this place. This is the current price right here. This is the current price. It's at 137, right? I hope you can see it properly. So when it's on this position, 0.0 level is a non-tradable level or a non-tradable zone, because that is the beginning of the reversal. All right, that is the beginning of the reversal from an uptrend to a downtrend. So traders don't trade this, okay? So for a pullback or retracement to be valid, we need to see at least 3 candles being formed on the downward or opposite side of the trend, okay? So let me zoom this place out a bit so that you can see what I'm saying. So this zone right here is non-tradable. Okay, this zone right here is non-tradable. Why? Because this is where the reversal started, guys. This is where the reversal started. So we won't trade when the reversal is starting. We are going to trade when the trend has started to actually go down. Okay, the lower it gets, the more momentum it has to actually go up for now, right? So this is that is that for 0.0 zone, and the next zone, okay, the next zone is the zone of 0.236, right? So let me show you what I am talking about. Let me just change this color so that it can be more visible to you. So this is the zone I'm talking about, the 0.236 zone. All right, so this zone is an area of a weak pullback. Traders often get scared to enter this zone. All right, traders often get scared to enter this zone, within this zone, because the pullback might not finish before you enter. So what it actually means is that whenever you see more than 2 candles or 3 red candles, which is 3 pullback candles, this was the highest high, right? And then maybe 3 red candles form just like this, indicating a potential pullback, and then the market went as low as this zone, which is the 0.236 zone. It might go up but it might not, go up to a very high level, because this place right here is the swing high. All right, so liquidity has been fetched or has been swept there. So traders often get scared to actually trade within this zone, because they are scared that the market might just take a little step and then continue to go down to the next zone. All right, so some people halt, some traders halt and watch, patiently watch. That is the power of patience. They patiently watch to see if the market is actually going to surpass this place right here, and if it doesn't surpass this place, then that means that the next low is going to be lower than the region of the 0.236. So on the chart, the next Fibonacci number is 0.382. 0.382. So 0.38 is often referred to as the shallow pullback level. So it is the first key retracement level where traders often make their entries. And when price pullbacks from this level, it is indicating a strong continuation. So if we are going to wait, you're going to see that this position here, this green position, let me indicate it so that you can understand what we're talking about. This green area right here, this green zone, right? This is the zone of the 0.382, right? So if the price were to actually get into this zone, let me just draw this Fibonacci a little bit wider. Good. So if the price was to get into this green zone right here, with confidence, you can be able to look for bullish confirmations like the bullish engulfing candlestick or the hammer candlestick, or a chart pattern like the inverse head and shoulder chart pattern that will support the proof that this market wants to go down. So whenever you see your chart, your price getting to this level, then there is a strong indication that the price is actually going to go up, right? So moving to the next is the 0.5, right? So this is the 0.5 right here, and the 0.5 is often referred to as the trader's favorite or the market balance. Some people call it the golden ratio. All right, so this level is widely watched because it represents a perfect halfway pullback before continuation. So if your price peradventure, let's say sellers were strong in the market, and then the price happens to actually go as low as this level right here, all right, the purple zone, which is the 0.5 zone, which is the golden ratio, then this is a more confirmation that the price will actually go back from this zone, from this purple zone that you are seeing right here, because it is indicating a perfect halfway pullback before the continuation continues. Now next on the chart is 0.618, right, which is the 61.8%. So this level is referred to as a deep pullback, right? So on this point, the sellers are beginning to overtake the market. All right, on this region right here, the sellers are beginning to overtake the buyers in the market. So it is actually trying to tell you that there might be a pullback, but the pullback might not be as strong as you think. That is just what this zone is talking about, right? That is just what this zone is talking about. So the last zone on the chart is the 0.786, which is the 78.6% ratio. So this is a no trade zone. The trend has already weakened right here, and the market might not pull back at this point. Okay, that is why it's called a no trade zone. I'm gonna show you one example so that you can understand what I mean. So guys, this is a chart, all right, of XRP USDT on a 4 hours time frame. All right, this is XRP USDT on a 4 hours time frame. All right, and as you can see, this is our recent swing low. All right, so this is our recent swing low. Bybit has identified it for us right here. All right, 1.9930, and then our recent swing high is somewhere around the corner, somewhere here. All right, so the market went up and then went to this swing high. Okay, this is the swing high. Let me indicate it for you. So this is the swing high, this is the highest point, and then the market went to this place over here, which is 0.38. Like I told you, 0.38 is the trader's favorite. This is where most traders want to enter into the market, right? This 0.38, and as you can see, behold, while the chart is on 0.38, the market actually moved to the upside, just like this. Okay, sorry, the market actually moved to the upside, right? So if you're using a high leverage or you are using huge capital, just this small movement is actually going to make you a lot of money. And don't forget that this is a 4 hours time frame. So a small movement, maybe a movement from this level, okay, from this level right here to this level, is equivalent to a movement of maybe from this level to this level on the a smaller time frame, on a 15 minutes or a 5-minute time frame. All right, so that's how time frame typically works. In case you don't know about that, it's an added knowledge. And when the market went to this position right here, it actually came down and retraced and entered the golden ratio. This is how accurate and how sweet trading with Fibonacci retracement is. So when it entered the golden ratio, it actually went back up. So this is where your entry is going to be. All right, so when the market gets to this golden ratio, all you have to do is to go back to the 15 minutes, right? Go back to the 15-minute time frame and then look for a bullish confirmation entry. We've talked about engulfing, bullish engulfing candlestick, the hammer candlestick, doji candlestick, and so on and so forth. You can even look for chart patterns like the falling wedge, like the flag indicator, like the inverse head and shoulder, the cup and handle pattern, the reverse cup and handle pattern, and so on and so forth. They are double bottom, triple bottom. They're all examples of bullish confirmation entry on the lower time frame. So when you get there, you see that entry, don't hesitate, just enter the market, because from this point, from this golden ratio, the market is actually going to move to this area, this non-tradable area. Then that's where you're gonna place your sell limits, or sorry, your sell order. So when you place your sell order on this area, you then wait for the market to actually retrace. And when the market is retracing, do not enter until you see a perfect entry on the 15 minutes. So when the market went as low as this point right here, right, when the market went as low as this point right here, this is a non-tradable zone. That's just what I was telling you about a while ago, that 0.78 is a non-tradable zone, and the trend has already weakened right there, and the market might not pull back at that point. Okay, so whenever it wants to pull back, you have to wait. So just wait until it makes another swing high before you enter the market, or you see a change of character. When a change of character appears in the market, only then can you be able to start using your Fibonacci again on the downside, because the market wants to go up, right? So, but as easy as this might sound, and as easy and sweet as the technical analysis indicator might sound, it's always advisable that you conjoin this indicator with other confirmation factors, or maybe other technical analysis indicators, right? So that you can be able to perfectly predict it. So there are candlestick patterns, there are technical analysis indicators that you can join with this Fibonacci retracement indicator, all right, to actually make your trade more accurate. So in this video, I'll be showing you how to support your Fibonacci key level confirmation with the Bollinger Band. All right, so let's get there so that we're not going to waste much time. So in order to turn on the Bollinger Band, all you have to do is to click on this indicator right here, this BOLL, right? So when you click on it, you're going to see 3 lines appearing. And in our previous video, we have mentioned that whenever the price, all right, when our Bollinger Band is turned on, so whenever the price hits the lower band, let me indicate for the newbies that are just coming to our channel. So this is the lower band. This is the middle band, which is technically the moving average at the period of 20, and then this is the upper band right here. So whenever price is within this lower band, right? Whenever price is within this lower band right here, this is the lower band. So whenever price falls within this lower band right here, or touches the lower band, okay, or even goes just a little bit below the lower band, it is indicating an oversold condition. And an oversold condition means that sellers have sold a lot of assets in the market, and now it's time for the market, like it's time for the assets to gain its value by being bought back into the market. So whenever it goes to an oversold condition, we are expecting the market to actually go up. So if you notice something, you're gonna see that right here, okay, right here, the price is hitting, or the price is within the oversold zone, which is the lower band, okay, because this is the middle band. As you can see, this yellow line right here is the middle band, and then this area where the price hits is within this lower band, okay, it's within the middle band and the lower band. So whenever price hits this area, then it is indicating that the price wants to go up. So if you want to combine it, you're going to see that the price is within this 0.618, all right, it is within this 0.618 area, meaning that the price might go up, but it might not go as high as this zone right here, the non-tradable zone. And that is what just happened, all right? So the price went high, but it stopped before it enters the non-tradable zone. You can take this trade and make profit, all right, and then wait for price to actually come down again into this oversold condition, this oversold area, and then price actually went down, okay, and went to the golden ratio, but then it made a small retracement and then came down to this other what is it called, this key level of Fibonacci retracement. All right, so when it got to this key level of Fibonacci retracement, it is making, let me show you something, it is making a support right here, right? So this is our support, because whenever price touches this level, it is tending to go up. All right, whenever price touches the level, it is tending to go up. So if the price gets to this Bollinger Band right here, and it is within these tradable zones, then you can be able to take your trade and actually make profit. But the moment price gets to this zone right here, then it is a no-go area because traders get scared. All right, so that is how you can be able to make money using this Fibonacci retracement indicator as your indicator that you're going to be using to trade the market. So also that is how it actually works over here. So if you notice something, whenever the price gets to this Bollinger Band area, this lower band area, it's going to actually go up. Right, even if it didn't get to the Bollinger Band area, at least it must first of all hit the middle band before it actually goes up. So whenever it hits the middle band and it appears that it is within the tradable zone, which is the 0.38 or 0.5 zone, okay, or 0.61 zone, you can be able to enter the market and then allow the markets to actually go up with you to the non-tradable zone before it actually goes down. Right, so guys, trading might seem hard to some people, and then trading might be so easy to some people. It depends on, so let's say it is subjected to how you perceive trading to be. Okay, there are some people that just get into trading with their $3,000, $5,000, $10,000, and then within 1-2 months that money has vanished. That is improper risk management, because there's no way that you can be managing risk and then a huge amount of money like that can go. And there are some people that do not stick to their trading rule. Okay, if you find a strategy that works for you, please do not, whenever you get to the market and then you see that there's no opportunity for you, don't force the trade. Do not force the trade. The market is there forever. If you miss one trade, there's more probability and there's high chances that you're going to see another trade. Okay, so when there's no setup, no opportunity, just ignore the market, go do some extra activities, come back later time and then get into the trade. Learn the art of patience, learn the art of being patient and discipline. And if you cannot at all be patient, right, then at least risk just 10% of your capital. Okay, so whatever happens, it's not all the capital. And do not forget, trading is the only platform, or is the only business where your mistake is being paid with dollar, not with punishment. So with this in your mind, you're going to know that in order to find money, you need to spend money. So that's where you're going to be disciplined, so that the money in your hand will not finish. I hope this video helped, and I hope you have a nice day.
On your path to greatness, there are going to be long periods of time where you hate what you are doing, where you are dissatisfied with the actions you must undertake, where you are tired, where you are stressed. That is why it is difficult. That is why most people won't make it. If the path was easy, everybody would walk it and it would lead nowhere.